It's the end of a week that will likely post losses, even though we got green arrows on futures. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, equities on edge ahead of a tight election battle and big tech earnings on the horizon. Plus, deal stocks are dropping after a federal judge sided with the FTC, halting Tapestry's $8.5 billion acquisition of Capri. A look at the antitrust landscape for you ahead. And revving up Scout Motors. CEO Scott Keogh joins us on how he's trying to energize American auto manufacturing. Let's take a look at where markets are trading right now. We are up in terms of futures. You're seeing green arrows on the screen. S&P futures up 0.4%. NASDAQ futures, tech earnings powering NASDAQ even higher, more than 0.5% right now. And the 10-year yield coming down as investors start to buy these bonds that they had been selling off. But we're still likely to see a loss in terms of equities for the week. And if we do, Sonali, it'll be the first losing week in the last 7 weeks of sessions.
Certainly, it has been a terror. Crazy to see that bond market come full circle. We'll talk about that. But first, some stocks to watch. A lot of movement under the surface. New York Community Bank shares falling after provision for credit losses missed estimates. Remember, the stock had already been down more than 62% this year and down another 8.7% pre-market. But people are buying shoes. This is really interesting. Deckers Outdoor up more than 13% pre-market, higher after boosting its sales forecast for the full year. But Capri, as you were talking about, Matt, it's sinking 46% as a federal judge blocks a planned takeover by Tapestry due to handbag market competition concerns. If you saw my mother's closet, you would not have those same concerns.
I was thinking about the shoes. I don't know what shoes Donald Trump wears, if he is an Uggs guy or if he wears Hoka's, but it does seem like the Trump trade continues to profit. If you take a look at a couple of baskets of stocks that Dan Curtis, our charts producer, put together for us, in red you see the Trump trade there, Republican outperformers, and in blue you see the Democratic outperformers, I guess the Harris trade. You can see that the Trump trade continues to accelerate, Sonali, and I also saw a note today from SocGen. They think the bond market has fully priced in a total red sweep, a Trump victory, and that, you know, you can start getting into that market now as yields may start to move lower after the election.
You have to wonder how far they move either direction, frankly, because you look at the 10-year, you were as high as roughly 425 earlier this week. We are down back firmly below that 420 level, so we've basically come full circle. Something I'm wondering about is what people are watching to determine that Trump trade, because you looked at what was happening on Poly Market, for example. Turns out it was only really one major whale among a few other smaller whales. But if that's something you're looking at to predict the outcome of the election, how indicative of it is it relative to those polls?
Yeah, I think the questions about Poly Market are legit and about betting markets in general, but polls have been wrong in recent big election events.
Nobody knows, let's be honest.
Well, predicted, I think, maybe a little bit better because it's more a market for academics. You can only bet a maximum of, I think, $850 on predicted. In any case, all of the betting markets have Trump fully ahead.
Somehow the next 10, 11 days are the longest and shortest 11 days of our lives.
Yeah, well, I think they're going to be
at the same time.
I think they're going to be long ones. Let's talk these markets with HSBC head of equity strategy for the Americas, Nicole Inui. And Nicole, one thing is for certain, even though we may have a losing week, equities have just marched higher and higher. I believe you've moved your target higher for the S&P 500. Why do you think that this rally has more room to run?
Well, you know, as we talked about at the beginning of the year, there's always this bull case scenario for the S&P. And what was the bull case scenario? That GDP growth would come in above trends. We wouldn't see the slowdown in the second half of the year as the market was expecting. Inflation would ease enough for the Fed to start cutting rates. And all of that would be very supportive for corporate earnings, and we're seeing that. So all the pieces are really falling into place for the S&P, for equities. Just looking at GDP growth for the second half of the year, the market is still expecting a slowdown, but we're still seeing GDP growth growing very strongly. You're seeing actually consensus that continually needs to revise higher their GDP growth, so they're still behind the curve. And so we're always looking at this difference between expectations and reality. And really the expectations, I'd say, for GDP growth are low. We could see that surprising on the upside, and then also on the corporate earnings aspect as well. So first quarter earnings beat, second quarter earnings beat, and we're heading into this third quarter earnings season. It's still very early, but we're seeing almost 80% of the companies beating on an EPS and really going into this earnings season with expectations very low. So consensus is expecting earnings to grow only at a 4% rate, which is a pretty big deceleration from the 12% we saw in the second quarter. So we're going into this time with the macro looking very good, and also the micro in terms of company fundamentals looking very strong as well. So the combination of those two factors are very supportive for equities.
For sure, we continue to see, I was looking at the Atlanta GDP nowcast, as they ridiculously call it, and it continues to march higher. 3.43% is where we are right now in terms of their prediction. GDP is strong, as you say, and earnings have been pretty good, although it seems to me that a lot of companies are relying, maybe I take too much out of Harley-Davidson because I love the products, but a lot of companies are relying on continued interest rate cuts. Nicole, do you expect the Fed to continue cutting rates? I mean, would they pause? Because, as you point out, things look pretty good. There doesn't seem to be much reason to take rates down.
Right. Well, we've always had the view that we'd see a gradual easing cycle. So our expectations for 25 basis points of cuts over the next 6 meetings. I would say if we get a pause, if we don't get all those rate cuts, at the end of the day, why are we not getting rate cuts? Because the economy is very strong. So I would rather see fewer rate cuts because you have a strong economy rather than more rate cuts because the economy is looking weak. And looking at earnings, yes, rate cuts is positive for those companies that have more leverage, as you'll see financial expenses coming down. But remember, a lot of the companies on the S&P, first of all, leverage ratios have come down. Second of all, a lot of them have these fixed rate, very long duration debt. So I would say that the lower rates for many companies won't have an immediate impact, especially for these companies, these large companies on the S&P that don't have a lot of floating rate debt. I'd say maybe different for the small cap space, but I'd say for the large cap space, I'd rather see top line growth. I'd rather see the economy growing stronger rather than them getting better EPS due to lower rates.
I think another important part of this, too, we can all get excited about a strong economy, but when do you start worrying once again that perhaps it's too strong to sustain a significant rate cutting cycle? You have, for example, Bloomberg Economics predicting an increase here in U.S. spending to contribute to more inflation for the core PCE for September. What kind of impact does this have at the end of the day? Do you share the same concerns?
Yeah, of course, I say the biggest risk to this equity market right now is a reacceleration in inflation. So inflation actually picks up, and we get to the point where we're not saying, oh, the Fed is going to pause. We're going to say, oh, the Fed is going to start hiking. We're not there yet. We're far from that. We continue to expect core PCE to decelerate at a gradual pace, and I think it will take various inflation readings of really strong acceleration for that view to shift in terms of what the Fed is going to do going forward. So again, we have this expectation of a gradual easing cycle. If it's not as much as we're expecting the markets pointing out, we don't see that as a huge negative because it's really showing that the economy is coming in stronger. And of course, at the end of the day, you're buying corporate earnings, and you want to see this strong nominal GDP, and that's what's feeding into this corporate earnings growth.
Nicole, great to get some time with you. Thanks so much for joining us. HSBC's Nicole Inui talking to us about these markets. I want to bring in Bloomberg's Alex Semenova right now with a look at some of the movers that we're watching this morning, some very big ones as a result, especially of deal stoppage or deal slowage?
Yeah, so taking a look at Capri and Tapestry, this is obviously a big victory for the FTC, which has been vying now for a year to block this $8.5 billion deal. Tapestry is the parent company of Coach and Kate Spade, Capri of Versace and Michael Kors. Basically, the FTC had been arguing that the merger of these two would stifle competition in the accessible luxury handbag market. And a really interesting choice of words by the judge. She said, antitrust has come into fashion. So basically, the judge blocked this deal, and then the FTC will further explore the deal and see, what kind of implications it has for antitrust. And it's also a victory for Lina Khan, which has been seen as a dynamite on Wall Street for antitrust regulation. Some critics have said that she should be focusing on other bigger mergers and not just luxury handbags.
And Matt, it's interesting. We are watching this in part. How many hedge funds had this trade on Millennium, Hudson Bay, Pentwater, Citadel, Balyasny, Greenlight? A lot of people were betting on a Capri win.
So they're all burned now, basically.
Something really interesting to note here is that over the course of the hearing, Capri shares rose from $35 a share to $42, moving closer to that $57 merger number. So that shows that people had been really optimistic that the deal would actually come through.
Alex, I don't believe in mergers.
You
He
don't.
only
There's no
believes
such
in
thing as a merger.
acquisitions or
That's
sales.
true. That's a
he
fair
likes to
point.
know very directly what the power dynamics
There's
are.
always an underdog.
Anyways, there's other things moving markets as well. Earnings in particular. What are you watching?
Yeah, Coursera is an interesting one. Shares are plunging this morning after they issued disappointing guidance and also said that they would cut 10% of their workforce. Now, what's interesting with this company is typically we see that often when we hear announcements about headcount declines, that's typically a sign that a company is trying to improve its profitability. We tend to see the stock move higher. But here, investors are focused on that disappointing guidance, which has been a big theme for the last few earnings quarters as people try to see, what's ahead for corporate America.
I noticed there was a story the other day about Denny's, right? Mm-hmm. And we said that consumers were moving down to the kids' meals to save money. But I was also thinking it could be because of portion sizes, right? If you go into a restaurant and you get something that's so big, there's no way you can ever finish it.
You think it's GLP-1s that are causing the downside?
I mean, maybe, right? If I can get a hold of some GLP-1s, I'm going to be shooting myself up right away. And yeah, exactly. But anyway, the stock is moving.
Yeah, the stock is lower today. Obviously we've been talking a lot about earnings, but this is actually due to analyst downgrades. Citi and KeyBank cited greater cost discipline. Sorry, the stock is rising. They cited a greater cost discipline and accelerated store closures. So interesting reaction here, given most stocks have been moving on earnings.
Did you have a Denny's? Was there a Denny's in Paramus? Because where I lived in Ohio, that was the place to be at like 4 o'clock in the morning for a big breakfast.
We did Applebee's, but
yeah. Applebee's is not a 24-hour place, though.
All right, we stayed there late. Anyways, next week is an even bigger week for earnings. What are you looking at?
Obviously, it's all about big tech next week. They've been powering those stocks, the S&P 500 rally since last year now, but we're seeing, tremendous profit growth profits slowing tremendously from last year. Going into this quarter, we're expecting earnings growth of 18% year over year compared to 40% last year. So a lot of the luster coming off of these big tech names. And obviously a big theme last quarter was that some of the laggards were outperforming. The equal weighted S&P 500 outperformed. So it'll be a really crucial moment for big tech. Will the cap weighted index go higher, or will we see some sectors like utilities and energy start to catch up to that trade?
Alex, we thank you so very much for keeping an eye on all of it for us. We'll talk a lot more about that in the show. Of course, big week ahead.
And we're going to talk about those tech-concentrated ETFs later on as well.
We sure are. Of course, some of them are hella levered, aren't they? Anyways, coming up, more on Tapestry, Capri, and Lina Khan's big win. We're going to take a look at what the M&A landscape could look like in the next administration. This is Bloomberg.
Time now for high interest to look at what's making headlines around the world. Microsoft CEO Satya Nadella received a pay package worth $79 million for fiscal 2024. That's a 63% rise from his pay the year before. Around 90% of that, though, is in Microsoft stock. Nadella's pay would have been around $5 million higher if he hadn't asked for a pay cut to reflect his personal accountability for changes the company is making to reflect cybersecurity risks. This according to a regulatory filing. Anyway, the guy is getting paid a ton of money, but creating a lot of value for shareholders as well. Lenders to Dish Network told attorneys for DirecTV that its current proposal for a merger, which calls for those creditors to swallow $1.6 billion in losses, is unworkable. DirecTV rejected a counteroffer from that group of bondholders, which proposed adjusting a debt exchange that the merger will be contingent on. They told DirecTV you can negotiate, close the deal as it is, and pay a premium or face more litigation. And we've been talking about how a federal judge blocked the planned $8.5 billion acquisition by Tapestry of rival Capri. It's a major victory for the FTC, which has said it would be harmful to competition in the handbag market, and you know how important that is. The decision caught markets off guard. A lot of observers here of the hearing had predicted the FTC was more likely to lose the case, but Sonali, the handbag market for now has been kept safe.
Absolutely. You have to make sure that of all the dangers in the world, those handbags in particular stay away from any danger. Anyways, for more on what the regulatory landscape could be under the next presidential administration, we are joined now by our antitrust analyst, Justin Teresi of Bloomberg Intelligence. And clear win here for Lina Khan, but wondering, there has been so much pushback against kind of these anti-merger sentiments coming out of the FTC. Does this one win mean that the direction of travel is very clear for the future of antitrust and deal stopping when it comes to just worries about competition among industries?
Hey, Sonali, thanks so much for having me. So, I really think that this is a huge issue with the election here. And I think no matter who wins in a couple of weeks, I think that's really going to define what we see now for the future of enforcement and M&A kind of review, if you will, at the FTC. I think, and really, no matter which candidate is victorious next month, I think chances are Lina Khan might be on the line here in terms of being reappointed for a second term. There's a lot of pressure from the left for Harris to keep her if she wins, but at the end of the day, I think that the whole idea of a president having their own view and their own staff really across their cabinet suggests to us that she might not be reappointed, as some folks are pressuring Harris to do.
In terms of Lina Khan's ability to stay on, Justin, we know J.D. Vance, famously a fan, but would Donald Trump keep her on? Is there agreement on that ticket in terms of this kind of FTC enforcement?
So I think on that particular point, the answer from our view is a resounding no. I think that even though J.D. Vance has really been out there and has expressed some level of support for Lina Khan, at the end of the day, Donald Trump is very unlikely to appoint her simply for the fact that I think she could be seen as kind of rogue in the action she would take at FTC. And Donald Trump already went through a bad experience during his last term with his FTC chair, Joe Simons, who he saw as not particularly loyal to him either. So I think all of that kind of in the stew here with what the next administration looks like, I think it's very unlikely, no matter whatever the level of fandom might be for Lina Khan, that both candidates really take a hard look and probably don't reappoint her in their term.
How do you feel about the way the FTC has been using their power in this administration? You know, one thing that was interesting in the commercial break, me and Matt were kind of talking about where the Chevron doctrine really applies here, and where there will be kind of erosion of that after the Supreme Court hearing. And you made this great point that that really implies more to the rulemaking, not the enforcement, correct?
Right. But I will say, while Chevron really relates to rulemaking at the federal agencies and how they go about setting, these rules that, regulations that we all kind of live by, what is happening is that the kind of aggressive stance that FTC has taken lately, and this involves things like the suit they recently brought against pharmacy benefit managers and the mergers that they're choosing to block, what it is doing is inviting these lawsuits that involve a constitutional challenge to the FTC's own internal administrative tribunal, right? So with every one of these lawsuits that might be brought by the FTC, it's interesting to see how that plays out in terms of courts' review of whether or not their internal tribunal is actually constitutional. At some point, looking at courts like the Fifth Circuit, we could see a situation where that actual constitutionality of their own internal review process really ends up on the line as well.
Justin, great to have you here, and it's awesome that we have such a great bench of legal and regulatory experts from Bloomberg Intelligence. So thanks so much for joining us. Justin Teresi there of BI talking to us about the FTC and what it's going to look like in the next administration, depending obviously on who wins, right?
What I think is fascinating when it comes to deals in particular, there's some sentiments that both parties really adhere to. You think U.S. Steel, for example. Of course, both parties have been
protectionist.
Totally. And then when it comes down to big tech, you have to wonder whether big tech could get bigger under either administration. So there is some overlap, but clearly a deal like this might be more likely in the future.
Yeah. Might be more likely in the future, right?
A lot of questions.
Yeah, there are, and some of them will be resolved in just about 11 days. Coming up, the E. coli contamination fallout continues as Taco Bell, KFC, and Burger King pull onions from some of their locations. Social climbers next. This is Bloomberg.
And it's time now for Social Climbers, the companies making waves this morning. First up, Yum Brands and Burger King are removing onions from some of their locations as the restaurant industry investigates an E. coli outbreak first traced to McDonald's. Yum withdrew from onions from some Taco Bell, Pizza Hut, and KFC locations out of an abundance of caution, according to the company. Next, Morgan Stanley choosing Ted Pick to be its next chair, succeeding James Gorman, who was tapped to head the Walt Disney board, but Gorman will step down as executive chair of Morgan Stanley at the end of the year. Finally, Deckers Outdoors getting a head start today after reporting second quarter results that beat estimates and boosting its sales for the full year ahead. The maker of UGG boots and Hoka running shoes is capitalized on its popularity among teens as competitors like Nike continue to struggle. You can follow all the latest company buzz on TRNG Go on your Bloomberg terminal. Matt, are you buying those Uggs this season?
I don't. Well, definitely not. But you have kind of a hippie vibe today. Which...
Oh yeah, this is what I do. Cowboy boots in the summer, Uggs in the winter. They're coming.
I like it. All right, we're going to come back with a look at these markets. Futures up. This is Bloomberg. We are moments away from the start of trading on this Friday, October the 25th. This is Bloomberg Open Interest. I'm Matt Miller. You do see green arrows on futures right now, just a third of 1%, a little more on the S&P 500. We're down right now almost 1% for the week. So we'd have to really put up some serious gains in order to finish this week in the green. So we likely won't, right? It'll be the first down week in the last 7 sessions, but I don't want to bum you out. OFG Bank Corp, along with 60 Años Oriental, ringing the bell at the New York Stock Exchange. There's a biotech company, Septerna, at the NASDAQ market site. In terms of the major averages, again, we're going to see gains today, but not enough to bring us back to positive for the week. I guess we had a pretty good weekly run anyway. 6 weeks of gains, 30 days without 2 back-to-back losing sessions until the beginning of this week. NASDAQ doing better than the S&P as tech stocks continue to power higher right now, up 0.7%. And the small caps are doing okay as well, up 0.6% right now. The question is how those small caps fare if we start to price out Fed cuts. I'm going to talk to John Stoltzfus from Oppenheimer about that in just a moment. Sonali?
Don't count out the small caps. There are a couple stocks on the surface we're keeping an eye on as well. We're going to watch shares of Tesla shedding some gains here. Remember, they were just flying a day ago after rallying 20%. CEO Elon Musk said the EV maker is poised for sales growth of up to 30% next year. Now, Tesla only down about 1%, so nothing to cry home about after what we saw yesterday. Bring back up Capri and Tapestry. Remember, we were talking about that U.S. judge blocking the proposed $8 billion merger. The judge cited competition in the accessible luxury handbag market, but you're seeing different reactions. Tapestry's actually up about 10%. Capri down still more than 45% as the market opens. It's a good day to be a sneaker company, though. Also taking a look here at Deckers, the company behind Hoka and UGG, surging here after boosting its sales. You have Deckers up almost 11%. Skechers also boosted its outlook, and On Holdings is higher after the sector news today. On is up almost 3.8%. Skechers fluctuating, but up about 0.4%, Matt.
All right, let's bring in Oppenheimer's chief investment strategist, John Stoltzfus, joins us now here on set. Great to have you in the studio, John. What do you think about the Fed continuing to cut rates? I mean, everybody seems to have that penciled in, but we're looking at 3.4% in terms of GDP growth. Earnings are beating expectations. Stocks are at an all-time high. Corporate spreads are at tights. Why?
Well, you know, Matt, I think what it is they are really focusing on the other half of their dual mandate, and they really want to make sure that the full employment rate stays intact. So around 4%, somewhere nowadays it's between 3 and 4%. They want to, if it's 4.1, 4.2, that right away tells them they have to be careful.
I mean, the average has got to be much closer to 5.
Yeah, it probably does. But the current situation would say that Powell very much wants to avoid a situation where he would find a flashback in terms of inflation. But at the same time, he wants to avoid, as companies looking ahead are now beginning to more and more, you hear it all the time, whether it's technology, reducing the employee base, or selective groups within the sectors. When that happens, they just don't, and then you have the hurricanes that have happened, the storms. So I think we could get 2 cuts by the end of the year, if and as needed. So it's as needed and it's if needed. They may just avoid cuts at all.
Well, that's the thing. Is it needed? Because you saw the earnings story, and many companies are actually holding up very, very well.
Sure.
And if you look at the past week, it's actually consumer discretionary that performed better than anything else.
Isn't it wonderful? You know, that's one of my favorite sectors because it's been an underperformer this year. And we always say, don't bet against the American consumer because the resilience is extraordinary.
People forget that.
Yeah.
Every cycle, people forget.
Every cycle.
People are worried about the consumer weakening at this part of the cycle. What is the risk that you do see weakness heading into next year?
Well, I think the risk that we really see is beyond next year. But the most important thing we think is once we know what the outcome of the election is in all 3 houses, the White House, Congress, the House, and the Senate, at that point, the market will have an idea. But even more important is once you're beyond Inauguration Day, you've got a year that's almost, there's some kind of a honeymoon that usually happens. Think back to 2017, and then think back to 2021, were honeymoon years for the president who had just been inaugurated. But then in the year that follows the inauguration is when the rubber meets the road and you get an idea what the policy changes actually are, what has been able to pass through Congress. So we'd almost think that we got a pretty, 25 may prove to be a pretty good year when we look at it because it will be election resolved. Let's see what happens. Most important, is the environment still one in which revenue growth and profit growth can continue, and you can see resilience in job postings, even at a slower pace based on all the hikes that occurred this hike cycle. So we remain positive on this thing.
I mean, I go back to the consumer, and I go back to Harley Davidson. They cut their sales outlook 14 to 16 to a drop of 14 to 16%.
$50,000 per bike.
Well, those are for the CVOs. That's just the bikes I want, right? But even a regular bike, a regular Harley, you could pick up for new for 15 grand, right? And this is, I think, the sort of quartile of the consumer that we're a little bit worried about. If you're not buying bikes, then if you're not buying Harleys, then you're strapped, right?
Well, you know, I think that I think the issue really is it's that the consumer diversifies their spending and they go for perhaps experiential things that may be a short trip to see a friend. Or they may go to discount stores, or they may buy private label. But that's the most important thing that and then the balance sheets, both of the consumer and business, this cycle have been extraordinary. Some of that, by the way, I believe it's because the financial news segment of our journalism tends to be so good at getting the message out that people are actually more sophisticated today. And the market and the consumer is just better educated.
You know, I want to go back to what you were talking about the election. Election night. What are you going to be watching for? Is it the S&P? Is it the dollar? Is it the bond market? What is going to be the clearest
What are the assets on your dashboard, John?
Oh, I'm overweight equities at this point. I'm considerably underweight fixed income, but that's generally our position. I'm an equity guy. But I am cyclicals over defensives here. Favorite sectors include information technology, communications services, which has the traditional telcos, but it's also got, of course, the search engines. It's got social media, and it also has as well.
But I mean, if you were in financial news, right? If we're like, hey, John, we need you to put on an election night special for us, and the graphics people said, John, which assets do you want to have up here when the results start coming in? What are you watching?
I'd say what I'd be watching would be primarily Congress, and then I would also be watching, of course, the presidential election. But the most important thing is
bonds. Would you put up currencies? Is the dollar?
I'd have them all up on my screen. I've got, I go everywhere from short-term treasuries right on through commodities, currencies, sectors, market capitalizations, style. And believe in broad diversification. Because I also, like I said, aside from those two sectors, consumer discretionary, industrials, and financials, because those are the things that touch the economy and the population the most, really. Healthcare, it does also, but healthcare's got political problems, both sides of the aisle, in terms of how to deal with profitability.
It's interesting, and you're not the only one that's told us that they'll be watching so much that night. And my question is this because you've seen such an aggressive Trump trade put on into the days of the election? If he doesn't win, do those drastically unwind? And is there a Harris trade put on instead?
I'd say invariably you would see some kind of unwind, but I think that the trade is not so directional as it might appear to at first glance. I think if you look at the rallies that we've seen this year, it's broad diversification. It includes both cyclicals and defensives. The smalls and the mids are getting to play a role here. And as a result of that, we think a lot of the population within the market today it really is represented, we'd have to say, not just by fear and greed and the action of the moment, but genuine need, whether it's to put a kid through college, whether it's preparing for a retirement in a world in which Social Security is no longer to play as big a role as it did, and defined benefit programs are long distant in the rearview mirror. We think there's reason to believe that the actual structure of the market is intermediate to longer term related, and people have become accustomed at the support they get by a Federal Reserve that has been remarkably sensitive in applying its dual mandate.
Addicted is a word some would use. Addicted is a word, rather than accustomed, no?
I would hope not addicted. I think addicted gives it the shock value, Matt. But I would say, it depends. When we speak with investors, we've been really big. It's not about buying the dip, but about catching the babies that get chucked out with the bathwater when the traders throw everything down like a hot potato on some kind of a catalyst that appears that lets them sell without FOMO in the midst of a big bull market.
John, awesome having you in the studio. Hope you come back and visit us. John Stoltzfus there from Oppenheimer. Coming up, Apple is cut by KeyBank on fears of unrealistic expectations ahead of earnings. Details on that and more in Top Calls next. This is Bloomberg. It is time now for our top call, some of the analysts' action in focus this morning. First up is KeyBank, as we told you before the break, cutting Apple to a sell. The firm says the tech giant has unrealistic expectations for growth and its valuation is too high. Apple reports earnings on October 31st. You can see investors not troubled really by that call right now, up a third of 1% at 231 and change. Next up, Citi is upgrading Denny's to a buy. The firm says the breakfast chain is getting better at controlling costs and it is closing stores. Denny's announced earlier this week it would close 150 restaurants and slim down its menu. The stock is up right now almost 6%. Finally, Jefferies says Boston Beer is no longer a buy, downgrading the brewer to a hold. The firm says it thought beer and cider sales would improve over the summer, but instead the numbers got worse and other growth avenues are limited for Boston Beer. You can see the shares are down now almost 5%, 288.19. Sonali?
Sadness. Not enough pumpkin spice beer. Anyways, the latest IMF Global Financial Stability Report says near-term financial stability risks have remained contained, but there are vulnerabilities from lofty asset valuations and climbing debt. We're going to discuss this with Tobias Adrian, IMF Director of the Monetary and Capital Markets Department. You know, I want to kind of hone right in here on a specific part of your report, and that surrounds the non-banks. Obviously, a lot of attention, but this market has been growing rapidly, particularly this year. If you had to bring it down to the single biggest issue when it comes to what you're watching around the burgeoning non-bank system, what would that be?
Yeah, so let me start by pointing out that U.S. capital markets are foundational for global capital markets, and the bond markets, both treasury and corporate bond markets, are very important for the U.S. economy and the global economy, hence our focus on that segment. So what we are watching particularly carefully is, on the one hand, the easy financial conditions, credit spreads are very tight. But on the other hand, we have seen episodes of sell-offs, and we try to very carefully assess to what extent there could be further such vulnerabilities.
Well, when you think about those vulnerabilities, another part of your report that touches on a part of the market that is considered liquid but may have liquidity mismatches, it's bond fund ETFs and mutual funds. When it comes to the specific concerns there, obviously you've seen significant inflows with the rate cutting cycle and where spreads have been. What is your concern here?
Yeah, so what we're looking at in the report are leveraged bond funds, so both leveraged mutual funds and levered ETFs. And what we are seeing is that those levered funds tend to have more capital inflows and outflows at risk. So it's not just that they are levered, so have more maturity and liquidity transformation, but they also have more flow volatility. So we're watching closely to what extent those are stabilizing or potentially amplifying market moves and in certain conditions.
Hey, Tobias, back on August 5th, which seems like a lifetime ago now, we had a little bit of Volmageddon, and markets dropped on concern that the carry trade was going to be unwound, or maybe because it was going to be unwound. I know it's hard to measure, but it's something that we spent many weeks talking about. Is that a risk looking ahead?
Well, when we look at the carry trade itself, there was certainly an unwind, but it was fairly orderly. Exchange rate moved, but it was not in a disorderly fashion. We did see a sell-off in equity markets, and implied volatility spiked both in the US and in Japan. But markets were able to absorb the shock and really rebounded very quickly. So I think it was a big move, but then it was also a very quick reversion. So there were sellers and there were buyers. So on net, the outcome is positive. But of course, it's something we are watching closely, and we are looking at various angles to really make sure that global financial stability continues to be sound.
At the end of the day, it's interesting because the Federal Reserve, in its own stress testing of the banks this year, did include hedge fund leverage as part of their assessment, not the critical assessment, but in other parts of their assessment. So when it comes down to your analysis, are you more concerned about the hedge fund industry or actually that of private credit, given how much you have seen the industry grow, attract interest from big institutional investors and retail investors? Tobias, if I think you're worried about bond funds, how would you feel about private credit wrapped up into an ETF?
Yeah, so from a policy angle, we really try to get a very comprehensive picture. where there are pockets of leverage and maturity transformation. We did a deep dive into private credit recently. It continues to be a relatively small market in the overall credit markets, but it is growing quickly. And of course, cumulative returns have been strong. So we could expect there to be further inflows. But from our visibility, the degree of leverage and maturity transformation continues to be contained. Now, it is, of course, important for the banks and the dealers to manage exposure to private markets, private credit markets, and hedge funds carefully. And so looking at both the infrastructure and market functioning issues, as well as the counterparty credit risk management issues, remains key to assure financial stability.
Tobias, we thank you so very much for joining us this week. Of course, that is Tobias Adrian of the IMF, off of their very closely watched financial stability report. Now, coming up, more in the world of finance, Wall Street's favorite new tool, tax loss harvesting. It was interesting before and ever more interesting in the future. We're going to give you details on why next in our Wall Street Beat. This is Bloomberg. And it's time now for the Wall Street Beat. We're looking at today's big take. So many Bloomberg things to keep an eye on. Wealthy investors are using tax-aware long-short strategies to generate losses. Those losses can then be used to offset capital gains taxes, allowing investors to minimize their tax bills. Here with more is Bloomberg's Justina Lee. And, part of me wants you to go into the nuances of how this is working at this juncture and why it's taking off. I mean, the numbers in your story are stunning. But first, I think we have to just kind of talk about what's at stake here and how this would work if Kamala Harris were to win the election, because it wouldn't work the same way, would it? Yeah, that was
right, exactly.
That Justina explained.
I don't think Kamala has made it clear, right? That what I got from your story, and we're talking about whether or not she would tax unrealized gains. She hasn't said that. I mean, I read that, I thought, in multiple parts of your story.
Yeah, that's right. And I think that was kind of a pretty big controversy at the time, because she said that she would support President Biden's earlier budget plan, which did include a minimum tax that would tax unrealized gains on billionaires. But more recently, when we asked her campaign, they've kind of declined to give a lot of specifics on that. And I think that really is the core here, because for the longest time, taxpayers, they have the option to choose, to sell their losing investments, to defer selling their gains, which kind of means that you don't have to pay your capital gains tax bill as your wealth grows. And I think that's pretty controversial for a lot of people who are very worried about income inequality, but that's just has always been how the tax code works.
And to be clear, we are not clear on her strategy, to your
point.
No,
we're not. And
exactly.
When we talk to even Democratic donors, when we talk to Alan Patrikoff, he's like, I'm not worried about it. It's never going to happen. And come on, this is America. That's terribly unlikely to happen. That's the kind of thing that they do in France, but not here. To me, the interesting thing is you can offset so much in terms of your capital gains. You talked to Cliff Asness of AQR, at least you looked at some of his strategies and found with big money, you get really big returns, right?
Yeah, and it's actually pretty neat, because I think a lot of people are familiar with, basic tax loss harvesting, where you're trying to just sell your losing investments to offset your gains from elsewhere. But the problem with that is a lot of the time, with investments going up over time, you just run out of things to kind of, tax loss harvest on. But the good thing about kind of longs and shorts is you're using leverage, and you have these shorts, which are bearish bets. And so it kind of means that, no matter where the market goes, you will always have losses kind of on your portfolio somewhere, even if generally your portfolio is still making money.
I would say it's one of the best stories I've read on the Bloomberg in a long time, Justina. And there's a ton to choose from. So congratulations on the story. I'll recommend to viewers, just go to Bloomberg.com and check out the story. Wall Street takes tax loss harvesting to a powerful new level. It's an incredibly good read, but you really have to pay attention and figure out the mechanics behind it.
You do. Read it twice even. But look at this. The S&P 500 is even higher than we started the market day, up 0.7%. We'll bring you more markets soon. This is Open Interest. Stick with us.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak.
And as Sonali pointed out, we're looking at continued gains here. So the markets are rallying on this Friday. Coming up, the race for the White House down to the last 11 days. We'll have the latest on the campaign trail as Trump heads to a Madison Square Garden rally. And the CEO who tamed one of the world's most troubled banks, an interview with Deutsche Bank CEO Christian Saving coming up at the end of an hour. That's one you don't want to miss if you work in this industry. Plus, revving up Scout Motors. That's a fun little pun because it's going to be electric. CEO Scott Keogh joins us on how he's trying to energize American auto manufacturing. They'll produce those EV trucks right here in South Carolina. I guess we're in New York, but they will down there in South Carolina. Let's get a check on these markets, Sonali. Look at the rally that we're seeing.
If we get past 1% on the S&P 500, we could say that we are on our 7th week of gains. But I don't know, we'll get that. We are rising pretty significantly. It's already the 7th week of gains for that NASDAQ 100. Got a lot of questions here. If the big tech companies are still that safety trade, the 10-year back below 420, that number you've been looking out for. But that bond market buying is cooling a little bit. We are now at a stunning level of 419. That's exactly where we started the week, Matt.
Well, I mean, it is. I do agree with you that the moves have been interesting. Seeing the yield shoot up to 425. Now it's coming back a little bit, but it's still relatively high. And we just got University of Michigan sentiment numbers in that may appease the Fed a bit. In terms of the one-year inflation expectations, they're down to 2.7%. And the expectation was 2.9%. That was the last reading. In terms of sentiment in general, it's back up over 70 at 70.5. We were expecting a reading of only 69, and it was 68.9 last time. So things are moving in the right direction.
And it's interesting. You think about what a lagger those consumer sectors have been. We've been talking about consumer discretionary. This is more fuel to that fire. The consumers just find, listen, labor data's in a week from now. And even if it's down, the question is, was that the hurricanes talking? And so a lot of choppy data ahead of us, but a lot of really solid data about the strength of the consumer map.
All right, we're going to talk a lot more about consumer products, I feel. I feel Tupperware.
I want to go shopping this weekend.
Tupperware and handbags coming up. Joining us right now, though, is Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist. Emily, great to have you on the program. As I just said, UMich numbers moving in the right direction for the Fed. But does the Fed really have to cut? I mean, do they need to reduce rates when we're looking at 3.5% GDP growth, stocks at an all-time high, corporate spreads at tight, unemployment at 4%? I mean, why?
Yeah, exactly. And I think, Matt, it's becoming increasingly clear that that jumbo 50 basis point rate cut probably was not necessary. 25 would have been just fine. And what you've seen is financial conditions have loosened because of it. You know, we're seeing this notable backup in bond yields. That's not totally abnormal. After the Fed cuts, there's kind of a risk-on celebration that financial conditions have loosened. We saw it in years like 95 and 2001. And then on top of it, though, we've seen better than expected economic data. You just hit on it. We've seen the services side of the economy is booming with manufacturing services PMIs at 55.3. Retail sales are elevated. We've seen the U.S. jobs market adding 250,000 new jobs last quarter. So that's also caused rates to back up. I think what could sort of challenge this backdrop is now we're seeing borrowing costs higher. We're seeing mortgage rates elevated. So that could actually have a slowing impact on this economy that continues to reaccelerate. And then I'd say the final element that's going on right now is inflation. So I think it's notable, you just mentioned inflation expectations coming down a bit. That makes sense to me. We've seen commodity prices come down. We've seen continued disinflation traction, particularly in the housing market. But investors are pricing in this potential political outcome that suggests that inflation could pick up as a result of more deficit spending, as a result of potential tariffs being applied to the economy. So a number of things going on here. I think the Fed will keep going here, but at a slower pace.
What do you think, Emily, about the consumer? We're going to talk to Alex Semenova in just a minute about a bunch of consumer brands that are selling things well at a lower price point, right? Uggs, Skechers, Tupperware. But the consumer isn't buying the slightly more expensive stuff. They're not buying as many Harley-Davidson motorcycles. They're not buying the big Winnebago RVs. What do you think about the U.S. consumer?
Yeah, I think the consumer is in good shape. And by the way, there's a lot of UGG packages showing up at my house of teens and preteens. So I totally understand that. And I certainly like Tupperware. But there's, I think there's a bifurcation happening across the lower end consumer that's becoming a lot more price conscious. You think about credit card interest rates are still over 20% nationally. We're seeing delinquency rates pick up, but we don't think there's going to be a serious challenge to the consumer until there's more cracks in the labor market. Again, 250,000 new jobs added. We're seeing initial claims just remarkably low. And as Sonali suggested, there is going to be a lot of noise in the data given the impact of hurricanes. But regardless, we've seen a really healthy jobs market, which is going to support consumer spending. We also have this massive wealth effect. The S&P 500 is up 40% over the past year. So for any investors out there that have access to or have elevated financial assets, there's a wealth effect. Real estate prices are still at all-time highs. So I think that's making consumers broadly, even though there may be protesting higher prices in some categories, I think the consumer broadly feels pretty confident right now.
Newell Brands, right, makes Tupperware, and it's the bane of my existence, I will tell you. Like, my wife, for some reason, thinks we need 2 full cabinets of mismatched Tupperware bottoms and tops.
We recently moved. My boyfriend made me throw all of my 2 cabinets out. So I absolutely understand, but that means I'm buying new ones. So Emily, when you think about the consumer, it's not just the only unloved trade in this market that is finally getting a bid. It's also those small and mid-cap stocks that has regained favor among at least a group of investors. How much can those stocks hold up in this environment, especially when you know that perhaps many of those companies are unprofitable, many of those companies are fairly highly leveraged?
Yeah, we have seen small caps taking a bit of a breather here, and I think certainly the rate environment with rates backing up has been largely responsible for that. We have been underweight small cap equities, which has been painful during times when they've surged, particularly on this Trump trade, which suggests more cyclicality, a stronger economy would get rewarded. But when you look underneath the hood at small caps, just look at earnings season. Coming in pretty well broadly for the S&P 500, about 3.5% year-over-year growth is what's being tracked right now. But small caps are actually seeing negative 2% earnings growth. And that's what analysts are penciling in for the year as a whole as well. So we're seeing less quality there. To your point, about 40% of the Russell 2000 index is comprised of companies that don't make money. They're highly indebted. 50% of the debt of Russell 2000 companies is coming due over the next 18 months. So we're waiting to fully lean into small cap stocks until we're more confident that we're in an early cycle environment. Right now, we still believe we're in this never-ending late cycle environment where the lagged impact of Fed tightening hasn't tipped us into a contraction, and we're overweighting higher quality stocks that we think can fare better in this environment.
Emily, thanks so much for joining us. Good luck with the Uggs getting into the winter season if it gets at all colder. Emily Roland there of John Hancock Investment Management. Just want to point out that Newell shares are surging. I believe they're the maker of Tupperware. I'm pretty sure about that. In any case, they make some sort of home storage system. Those shares are up 23%.
They have
Is that right?
Rubbermaid. Tupperware is actually its own thing. But they have Rubbermaid, but also Yankee Candle. If you're buying people presents over the holidays, Coleman, Oster. Are you really in the kitchen a lot these days, Matthew?
I am in the kitchen a lot.
Actually, you're a good cook, I've heard. Yeah, that's true.
And yeah, I'm spending a lot of money on that kind of stuff as well because I'm not going to go buy a Harley right now. Not allowed.
But you will buy some Rubbermaid.
I have to go and buy, I mean, not Tupperware or Rubbermaid, but some kitchen stuff. Not Yankee Candle either. Anyway, let's stick to the big movers of the hour right now. Alex Semenova joins us from the stocks desk. She's got a number of companies, also focused to some extent on the consumer, right?
Yeah, all about the shoe stocks this morning. I'm taking a look at Decker Outdoors. It's up about 13% right now. That is the best day since May of this year. This is after they reported earnings that beat estimates and also boosted their sales forecast. This is the maker of Hoka's and Uggs. And again, it has to do a lot with Hoka's, which have been a really, really popular shoe running brand. They posted sales that grew 35% year over year for that specific shoe. Uggs also doing very well, boosting sales by 13% year over year. So as you mentioned, Matt, earlier, consumers are really, buying some cheaper products, cheaper shoes in this case.
Let's also talk about your expectations here for next week a little more. I am really curious because I feel like we're turning the page here. The consumer is doing fine. Most of the stocks are doing well. Starbucks is trying to recalibrate, so that's a different story. But, next week, Alex, I know you talked to a lot of strategists on Wall Street. Next week's a really big week. I mean, how much is on the line, especially after 7 weeks worth of gains on that NASDAQ 100?
So much is on the line, given that big tech is the highlight of the week. Obviously, that group has been driving the rally since late last year.
So it's like 20 trillion worth of market cap reporting next week.
Comprising a massive share of the market. And coming up until this summer, the Magnificent 7 index was up about 22% through that July peak and is down about 8% since then. So it's been really challenging for that sector. And next week will be a big test over what its profits look like. Obviously, they've had a massive profit engine last year, delivering year over year growth of about 40%. That is now shrinking to 18% year over year coming into this quarter. And we're expecting that some of the other groups will catch up. That earnings gap is supposed to close, but they really do have to deliver on results. And obviously, we'll be hearing what they say about artificial intelligence because we've had this year of massive expenditure, and we want to see those companies monetize on that.
Matt, every single stock today in the Philadelphia Semiconductor Index is in the green. So that tells you the optimism just going into next week, even with all that on the line.
And I mean, we look at, I think it's worth pulling up the earnings schedule again because there's such big companies there, kicking it off with Google and Reddit, AMD on Tuesday. But at the end of the week, obviously Amazon and Intel are going to be interesting. Apple, the big behemoth, $3.5 trillion of market cap, and it got a downgrade today.
Yeah, KeyBank Capital Markets right now saying that its growth expectations are basically unrealistic. They think the fundamentals are good so far, but they downgraded the stock because they think that, their projections are a little bit too lofty. This is actually the first bearish downgrade that they've had since initiating their coverage of the stock in 3 years. Their price target is about $200, which is 13% down from yesterday's close on Apple. That's their expectation.
Fascinating. You still have Apple shaking off that downgrade and still up about 6 cents.
Yeah, moving higher today. It was down earlier, and now it's rebounding along with that.
Also rebounding, fun fact, is Tesla, up now 2.6%. So really shaking off some of those valuation
Rebounding
worries.
from
The pre-market loss that we were seeing. Exactly.
Because they were up 22% yesterday. So, they're creating a ton of market value, not just for Elon Musk. I think like $35 billion. He got $35 billion richer, but for shareholders as well.
Anyways, Alex, we thank you so very much. That is Alex Semenova of Bloomberg News, all things stocks for us. Now, coming up, we're going to talk about politics. We're going to talk about Trump and Harris continuing their swing state blitz. We're going to look ahead for what's going on with both candidates next. This is Bloomberg.
Now to high interest, to look at what's making headlines around the world. Starting with Millennium and Athos Capital, among a group of hedge funds who've lost money after the surprise collapse of a deal involving 2 of China's drug makers. Both firms held around a 5% stake in China Traditional Chinese Medicine Holdings, that's the name, which saw its stock plunge after regulators didn't approve a take-private offer from state-backed Sinopharm. Both Millennium and Athos declined to comment. Now, it is 11 days until the election, and there are some early signs which may give the GOP cause for optimism. Republican voters have so far cast more early ballots than Democrats in 3 of the key swing states. More registered Republicans have voted in Arizona, Nevada, and North Carolina than Democrats. The Democrats, though, are enjoying a healthy lead in Pennsylvania's early voting with 60% of more than 1.2 million ballots. And it's time for the World Series. Ticket prices for games between the New York Yankees and the Dodgers, wherever they're playing these days, are soaring. The cheapest seats for Game 1 in Los Angeles are around $975. Tickets for Game 3 at Yankee Stadium averaging $2,000. That's the most expensive in history. You can score tickets behind home plate or above the dugout for a cool 20 grand.
Just incredible. Good luck to all those fans out there, and to Fox Network, of course, and to Mark Walter. These are two of the stories on the terminal worth watching about how much is at stake as you see so many viewers come to the table for that game tonight. Now, without 2 weeks to the U.S. election, let's get the latest on how candidates are positioning for that final push. For more on the political weekend ahead, we are joined by Bloomberg's Joe Matthew. And Joe, you know, I'm sure a lot of people would rather be watching the Dodgers at this point. But, you know, when we think about the election, we keep on joking around that these next 11 days are so fast, but somehow so long as well. A lot can happen. Let's start with Kamala Harris first, because it seems like this past week she's been trying to actually refine a lot of her economic message, but there have still been a lot of questions on the line, particularly as it comes to taxation. What do you make of that?
Yeah, it's apparently part of the real closing argument here that has been evolving for Kamala Harris. People thought she was kind of moving in the threat to democracy area that Joe Biden was in when he was running against Donald Trump. But her last big splash, her last big advertisement, a campaign that dropped just last night, is all about the economy, bringing prices lower and cutting taxes, as she says, for the middle class. Let's see how that sticks. The weekend here is going to have a lot to do with celebrity. We're talking more about Beyonce and Willie Nelson than we are policy at this point. And she's got a big rally planned for tonight in Houston, where those two will be with her following Bruce Springsteen last night. Donald Trump is in Texas as well. Interestingly, it's not a swing state, yet they are both there today. He's doing the Joe Rogan podcast. But in terms of closing arguments, what we're really hearing from the Harris campaign, the new sort of bumper sticker is she's got a to-do list, he's got an enemies list, trying to draw a contrast between the messaging from the two campaigns.
It seems Harris still wants to keep us in the dark, though, as much as possible, Joe, in regards to her tax policies. Sonali and I were talking about the potential for taxes on unrealized gains. Of course, she isn't saying how she feels about that. I always wonder about the SALT deduction cap. She didn't answer when directly asked that by Stephanie Ruhle. Is this part of her strategy, just not telling so that she can decide later, or do you think she just really doesn't know?
Or even just, Joe, earners over $400,000, right? I mean, how are we supposed to think about who's going to get higher taxes under a Harris administration?
Well, that's a lot of questions, which I guess points to the issue here with the campaign. Specifically when it comes to unrealized gains, Matt, you mentioned that. It's one of the reasons why we hear that Wall Street has an allergy to the idea of a Harris administration. Not only higher corporate taxes, but this idea that Joe Biden has flirted with and had proposed as part of this administration that is in the White House right now, the idea of taxing unrealized gains. You're right, we haven't had an up or a down on this. I will say Mark Cuban, who has been stumping on Kamala Harris's behalf, says he's talked to her about it, and that is not something that she plans to do. He also agrees that if that were to happen, Wall Street would have a fit. That would be a massive market reaction to a policy proposal, and also one that she would probably have a very hard time getting through Congress.
And as we found out lately, markets certainly matter. Joe, thank you so very much. We're looking forward to your coverage on balance of power, and of course, all your coverage through the next 11 days and beyond.
And maybe longer, yeah. The idea that this is going to get decided right away is one that I think we've thrown out. We're all expecting at least days before we know who is the president of the United States.
So you're going to want to watch us on November 6th, 7th, 8th, and 9th as well. Anyways, dinner and a charged EV battery ahead. Tesla getting closer to opening a 1950s-style diner, complete with charging station. Would you eat there, Matt?
Yeah, for sure. I just don't have anything to charge.
Anyways, social climbers up next. We'll talk about it. This is Bloomberg. And it's time now for Social Climbers. The company is making waves this morning. First up, Capital One reporting third quarter results that beat expectations. The bank notes that credit metrics have stabilized. Next, Beyond Hope? Beyond Inc., the owner of Bed Bath & Beyond and Overstock, was cut to a sell at Bank of America. The retailer announcing disappointing earnings at an investor event that fueled even more uncertainty about the success of turnaround efforts. The stock now down more than 4.2%. Finally, burger, fries, and a charged battery. Tesla is drawing up an eclectic menu as it prepares to open a 50s diner-themed charging station in Los Angeles. EV drivers will be able to grab a bite or catch a movie while topping off their battery. The move shows how the EV industry is moving away from the utilitarian gas station model. As someone, Matt, who grew up in New Jersey, I sat in my car while I got my gas.
Because in New Jersey, it's always full service. You can't pump your own gas in New Jersey, right?
I appreciated not getting out of my car.
Yeah, no, it's great. I love a full station a full service gas station as well. I was listening to this story on Bloomberg Radio this morning and thinking, first of all, I love 50s diners. I love diners, you know, no matter what decade. But that's how long it takes to charge the car. That should tell you something, right? You can go see a movie while your car is charging, and I just don't have that much time every time I want to fill up. I'm guessing the food will be okay. You can't do that badly when you're making burgers and pizza, right? So.
I mean, you can.
Yeah.
But, you know, it's interesting. I know we're going to talk to Scout Motors in just a little bit as well. You were saying you don't have an EV. I don't have one because I don't have a garage. And so there's a lot of hurdles here for the EV industry, let alone being able to go to LA, hang out with your friends who also have EVs.
Yeah, that is something that we can talk about with Scott Keogh. So he used to run Audi. He ran Volkswagen of the Americas, and now he's running Scout. And I wonder how quickly we're going to get charging infrastructure up to snuff, how quickly we're going to get fast charging, because at some point it's going to take only a few minutes to fill up your battery. Let's get a check on markets as we go to break. We're looking at a big rally on this Friday, almost enough to make gains for the week. S&P 500 up 0.9%. This is Bloomberg. All right, there's a lot of talk about nearshoring and reshoring lately, but Volkswagen takes it to a whole new level. International Harvester stopped production of the Scout on October 21st in 1980, so 44 years ago this week in Fort Wayne, Indiana. But in 2021, VW bought the Scout trademarks with the acquisition of the big truck maker Navistar. And this year, the company broke ground on a $2 billion production facility just north of Columbia in South Carolina. I'm pleased to say Scout Motors CEO Scott Keogh joins us now to talk about the brand's newly revealed Scout Traveler SUV and the Scout Terra truck. You can see those behind him. Both EVs set to hit the dirt and the road in 2027. So, Scott, this is pretty exciting stuff, and I've spent some time looking at the trucks. They look awesome. What can you tell us about when you're going to be done building the factory, how many people you're going to employ, what this kind of onshoring, reshoring, I guess retro-shoring means for the U.S. economy?
Yeah, Matt, thanks for asking the question. I think, as you referenced, this iconic brand, the godfather of SUVs, is coming back. If you go specifically to Blythewood, South Carolina, outside of Columbia, 4,000 jobs. And these are not going to be gig, I have no benefits types of jobs. High paying, good training, real medical benefits, daycare, the whole thing. Look, I think we've got to get back to the obligations of the past where people can have real jobs and get paid real salaries. So it's going to have a big, big impact on Blythewood. Plus, 21st century jobs, right? They're really going to get the training and get things that needed to have a competitive future, which is great.
As I said, the trucks look awesome, and I've already driven some EV trucks. I haven't driven the Cybertruck, but I spent some time in the GMC Hummer, and I'm really impressed with obviously the torque of an electric powertrain. But we have had a little bit of a backlash lately in terms of EVs. Do you think that lets up and they become more popular by the time we hit 2027?
Yeah, man, I think there's two things. One, the direct answer is yes. I think this is the right technology. Obviously, there's a little bit of chatter and noise. Nothing's linear in life. But I think the second thing, if you saw our announcement, we've got two drivetrains. One is all electric, 350 miles. The second one, super slick. We basically put a gas-powered range extender on the rear axle, over 500 miles of range. So now you're going to get a full battery car with a range extender. So we think we've got both options covered. Why we love it, keeps the platform flexibility, so we love it on engineering. More importantly, manufacturing flexibility. The plant can make either give and go, super flexible. So we think it's a great solution for America and great solution for Scout.
Scott, this seems like it's an interesting strategy, pivot, addition. I don't know how you would describe it, but how much of this is a hedge on consumer complement? There you go. How much of it is a hedge on how consumers might behave moving forward? Matt and I were kind of outlining a lot of the hurdles people have faced when it came to charging.
Yeah. Look, that's a fair question, and no one has a crystal ball. I think if you look at what some of the states are saying, right? 50% of the car market is basically saying legislation, 2035, you have no gas, period. So that's one end. The other one is, of course, we have to see how the consumer reacts. I think the best way to get the consumer to adapt is get them to trust and get them to love. And we think the extender is a perfect option to do that. It gives you everything you like about an electric car, right? It's got massive torque, massive fun to drive, over-the-air updates, a frunk, the packaging. Yet, when you need to go extended, you've got the gas. So we think it's a good complement. And again, what you want in the factory is to be able to push and pull depending on demand. So we've got a drivetrain that can go to 2050 in theory, depending on how America adopts. So some markets, as you know, are profoundly electrified, California, et cetera, and some are not. Scout wants to go to all 50 states. That's why we have this solution. So I think it's the right balance.
Can I ask, I mean, I'm excited about the hybrid powertrain. I've always thought it's the way forward. But I want to ask about pricing. I bought a Ford Raptor back in 2014. It was $58,000. When I moved back to the U.S. in 2022, they were $85,000. Obviously, prices have really climbed. What kind of pricing are you looking at in terms of these two models behind you? And what kind of scale do you expect in terms of sales in year one?
Yeah. Well, look, Matt, you asked the exact right question. So these vehicles behind me will be retail under $60,000 with incentives $50,000. So to get 1,000 pound-feet of torque, this kind of capable machine at that price point is phenomenal. The reason we're able to do that is you've got to be maniacal about material cost on the vehicle. We've done a good job about being maniacal on material cost. We've done a good job of bundling with the group in order to get costs down. Of course, the other thing we can do with a startup is you can really manage legacy costs. We don't have any. And of course, keep overheads down. So we've been really phenomenal about tracking that stuff. The plant is capable of making 200,000 cars. We don't need to get there overnight. We're going to ramp up accordingly, but we can make good profitability at less than that ramp up scale. So again, cost. And I think we've got the business model actually to do it. We've got good backing. And of course, we've got a clean sheet, no legacy cost, all of that, which is nice.
Scott, you know, you were talking about jobs, real wages, good paying jobs, good benefits here. Matt and I talk a lot on the show about the power of labor in this country and the increasing roles of unions and other organized labor. At the end of the day, where do you see the direction of travel going when it comes to worker needs and demands in different states?
Look, to me, I have no comment on unions. To me, it's always been quite clear in all of my manufacturing experience, and it comes down to two things. Compensate people fairly, treat them with respect. And in manufacturing, treat them with respect means looking out for their time. You see, again and again, come in Friday night, come in on Saturday, unscheduled shifts, on and on. If you can manage the shifts with respect, pay people fairly, we will do both of those things. The rest of the union issues takes care of itself. Labor issues takes care of itself. But at the end of the day, the employee, the worker, decides what they want to pursue. It's my job to pay them well and treat them with respect. That's what we as Scout Motors will do. I think, look, as I said, we have this philosophy. I think we do need to go back in time a little bit where you can make a fair wage, you can retire fairly, you can take a vacation, and not be in this ceaseless gig economy where you have $10 in the bank. It doesn't work. And as you said, employees are strategic. They're critical. They're part of our community. We're going to treat them right.
All right, Scott, great to get some time with you. Great to see those vehicles, and I hope we hear a lot more from you in the future. Scott Keogh there of Scout Motors talking about the new models that they've unveiled. I mean, what a story. You know, when I was a kid in the Granville High School parking lot, the cool seniors had these scouts. And just last weekend, I was at a Bring a Trailer car show in Bedford, and I saw 3 different International Harvester scouts. The profile, the silhouette is so iconic, and I'm excited to see what they do in terms of bringing this back.
Scout making a comeback, ripped jeans making a comeback. Matt, I know how you feel about those, but you know what? To each his own. Now, I'm going to bring us now to our weekly ETF report because there's another story closely tied to the market here and very tied to what we're going to see next week. Wall Street is rolling out a new breed of ETFs. Shocker there, with a varying degree of exposure to mega cap tech, including one that excludes the top 30 names in the NASDAQ 100. It underscores concerns about stretch valuations and concentration in this year's rally. And you kind of have a lot of flavors there to work from. The 20 largest S&P 500 stocks, the 30 largest NASDAQ 100 stocks, the ones without those 30 stocks. So, it's interesting. I wonder how investors might go long or short some of these. Do you want to lever up these trades a little bit more? But, I think back to a conversation with David Einhorn about why he thought the value investing industry was dead. And it was because passive investors have been helping bid up so many of these mega cap stocks. But, if you have even more concentrated ETFs, Matt, you have to wonder how much more profound that difference might be if there's just floods of passive money heading into the Mag 7 into next week.
I mean, I'm just typing out an email to Eric Balchunas. Is there no just Mag 7 ETF? I mean, that makes perfect sense to me, but I would want one that specifically focuses on those 7 stocks, right? And we have one for the 493, so it would make sense to me just to have 7.
I will say this, the ones that do track, say, a very large tech concentration already have been having stunning inflows this year. So even if you don't have money just in those Mag 7, I'm sure there is one to that effect. Certainly a lot of money flowing into those ETFs. Tune into ETF IQ every Monday at 12 p.m. Eastern. We will pepper Eric Balchunas for those answers. But up next, we're going to speak with Deutsche Bank CEO Christian Sewing about the company's latest results in M&A and European banking. This is Bloomberg.
Let's go live now to Washington, D.C. Bloomberg's Lisa Abramowitz is standing by with the CEO of Deutsche Bank, Christian Sewing. Lisa?
Hey, how's it going, Matt? Yeah, I am here with Christian Sewing, who's CEO and chair of Deutsche Bank, Germany's biggest lender here in Washington, D.C. for the IIF, the IMF, the IRF, and everything else under the sun. Christian, thank you so much for being here. It's really a treat to speak with you. And I want to go over a couple of the big themes that we see this week. The U.S. election, the growing divide between U.S. and European economies, and geopolitical risks. And I want to start with the U.S. election. How different is it between U.S. and European bank officials when they talk about the U.S. election?
I think there is not so much difference. Obviously, we are all observing it. I mean, we had a year of elections throughout the world. Half of the world's population went to elections. So obviously, everybody is focused on this one. I think from a European or German point of view, it is in particular, we are all focusing on what happens and what is the impact on the economic development, and in particular with regard to trade and tariff. And in this regard, there is obviously a lot of discussions in Europe. I'm always telling my clients, irrespective of the outcome, we all need to take into account that we have seen so many changes from a geopolitical point of view over the last 5 to 6 years, that we need to adapt either way. And it means that actually Europe needs to work on its home market. We need to make sure that our home market is becoming bigger, that we are really living one home market in Europe in order to be actually strong enough to compete with the US. Maybe that under President Trump, obviously from a tariff point of view, the situation will be even more challenging for European corporates. But we need to take the right steps right now. We need to prepare, and therefore, not only watching, but making sure that we adapt. I think that is the right solution, and that is the advice we as a bank give to our clients.
Do you see any signs that there is a willingness or ability of people, particularly in Germany, to adapt at a time where there's a real question about the main industry, which is auto manufacturing and competition from China?
Look, it looks potentially from the outside that there is no willingness and that the urgency is not understood. But I can tell you the willingness and also the understanding is clearly there. And obviously reports like the Draghi report, but also the letter report earlier this year are helping. Now, we have a complicated system in Europe with 27 member states. And obviously it takes time. But I would say that the understanding in Europe that we need to move, that we need to rethink the way we are defining our European home market, that we need to think about what can we do about energy prices, being competitive in this regard, that we need to think about actually reducing bureaucracies in order to allow investments. And finally, and in this regard, I'm actually quite optimistic, the tone when you think about also the financial industry, the criticality of the financial industry, that capital markets union is now on top of the agenda of Brussels, but also of the main European countries, tells me that the message is understood. Of course, we all wish that we execute quicker.
Okay, so let's go there. You're talking about the unification of a financial union at the same time that there was a lot of dissent from German regulators about the idea of UniCredit buying Commerzbank and a real question about whether that could go through. Do you think that there is a necessity for consolidation in the European banking sector in order for that strength to really happen?
In general, I think yes, there is. And we always said that. I have said that for the last 6 years, that if we think about the European banking environment and the banking industry, we are kind of overbanked. If you think about what is really needed when we think about the future, lots of investments into technology. If you think about the regulatory environment, I do believe that scale is important. But we also always said, from a Deutsche Bank point of view, first of all, some preconditions also on the regulatory side needs to be done. Sometimes at these, or in where we are right now, so to say, consolidation is not that easy from a regulatory point of view, where we stand, not finalized banking union and so on. And from a Deutsche Bank point of view, we always said, look, we have a clear strategy for 2025. We want to increase our return on equity, and we are on a very good way to above 10%. And therefore, we are focusing on ourselves. But industry-wide, it must come, and it will come over the next years.
Do you think, though, that there would be a much bigger competitive advantage for Deutsche Bank to be a bigger bank, especially when facing off with the JP Morgans and the Bank of Americas and the Citigroups of the world?
Well, first of all, I'm very proud that in those businesses where we are today, we can face off also the American banks. And we have a good market share. If you think about the FIG business in the investment banking, in the corporate bank, honestly, we are among the top banks. And I'm really proud where we focus on, we are among the leaders. And, you know, it's all a matter of time. But for the time being and for the next years, Deutsche Bank has such a potential to grow its profitability by itself, to grow and look from where we're coming. I took over the bank with 24 billion of revenues. Now we are heading 30 billion revenues in 2024. We reduced the cost. Why shall I look outside if I can do the next steps on my own? That's my whole focus. You know, I'm not talking about the years after the next years, but for the time being, only focus on ourselves.
In the recent earnings that you just reported, right before flying out to Washington, D.C., you reported a 42% gain on revenue, which is fantastic, quarter over quarter. You also increased provisions for loan losses, and this was on commercial mortgage debt and a whole host of other assets. A lot of people are tying this to some of the slowdown that we've seen in the German economy. Do you think that's accurate?
No, I think we need to be very precise when it comes to the loan loss provision of Deutsche Bank. First of all, to be honest, I think we are still a bank with a very low risk profile. Our loan loss provisions are, over the last year, somewhere between 25 and 30 to 35 basis points. If you compare that internationally and globally, it really shows that it's a low risk profile. Now, there are 2 or 3 specific reasons why we have shown an increased loan loss provisions in Q3. We still have some impacts from the backlog situation on the Postbank integration. That will go away. Actually, we will even see some reversals of loan loss provisions in 2025. Then there is, so to say, a little bit more complex items that for 1 or 2 exposures, actually, we had hedges in place, but we needed to build the gross loan loss provision. But we got the hedge income via the revenue stream. So on a net basis, very much controlled. And on commercial real estate, to be honest, we saw in the third quarter, for the first time, I'm really happy about that, a reduction in loan loss provision. So we think we have seen the peak. Valuations are coming back. Obviously, reducing interest rates are helping. To be honest, I think Deutsche Bank has seen the peak of loan loss provisions in the third quarter from a quarterly number. I'm very, very confident in our risk management. I've done that for 25 years in this bank, so I think I know the book, so I have no doubts.
I think people are not as concerned about some sort of existential risk to Deutsche Bank or anything like that. The concern is really, where is growth going to come from? Because right now, the German economy is not showing it, and you're seeing actually a contraction. And you're seeing concern about businesses, about how much production can be absorbed given some of the lack of spending. How do you grow? Do you move outside of Germany? Do you increase your exposure to places like Italy and Spain and France and the U.S.? Or is there still an opportunity?
Well, there are a lot of opportunities, and that was always the reason, Lisa, why we decided as Deutsche Bank to be a global bank. I love my home country. We have approximately 38 or 39% of our revenues in Germany. But I think it is so important in this world, which we are experiencing, to be globally diversified. And the advantage of that we are seeing right now. Our growth rates in Asia, in particular playing also the European-Asian bridge, are really nice. And the momentum I see, it is simply growing. We have a nice business in the US. We are doing almost 20% of our revenues in the US. We are not offering each and everything in the US, but there where we are offering, we are actually even gaining market share, which is good. And then, look, we always said we want to be the global house bank to our corporate and private clients. In particular, in a time of uncertainty, of geopolitical uncertainty, you cannot imagine how many clients are coming back to us and are asking for our advice with regard to changing their networks, making sure that they are diversified, opening other markets. And there we can help. And therefore, the situation, as challenging as it is for a global house bank like Deutsche Bank, is actually an opportunity to advise their clients in this challenging situation. And that's what we are seeing. The momentum of the revenue side, very positive.
How much more are you seeing that from clients looking to diversify where they are or move away from certain countries?
It's a constant theme. I would say it's a constant theme since approximately 2 or 3 years. Of course, the COVID situation, but also the awful invasion of Russia into Ukraine have really, in my view, sharpened the risk management muscle of our corporate clients. And they are thinking far more about diversification than ever before. And in this regard, they are looking actually for a bank with a global exposure, with a network in over 60 countries. And therefore, it's a constant theme which we've seen for the last 2 years. And actually, it is still further growing.
What region is the best for you, or the one that you're focused on for expansion?
Well, from expansion, I would say there is a lot of activity actually in Asia. Also there, if you think about the diversification there, I will always said it's not about decoupling from China. It's all about diversifying. And we can see a lot of momentum actually and action happening in actually diversifying business opportunities from our corporate clients within Asia. Going to outside of China, going to India, going to the southeast of Asia. That is the reason why we are in more than 17 markets in Asia. So that is clearly a growth market. Don't underestimate the Middle East. I think it is for the next years, it's a growth market. We invested heavily on the private wealth management side, but in particular also in the investment bank on the Middle East. And then from a product point of view, we took actually 18 months ago, we took the clear decision to grow our fee business in the origination and advisory business, because we always thought at some point in time, net interest income will reach its peak. We need to increase our fee business. That combined with the advisory needs of our clients is a real opportunity that we want to be strong in.
Christian Sewing, thank you so much for being with us. That's Christian Sewing of Deutsche Bank. Back to you.
Lisa, thanks very much. Lisa Abramowitz there in Washington, D.C. with Sewing. Very interesting interview. Of course, the question right now is Does UniCredit end up taking a bigger stake, maybe all of Commerzbank? Does the German government figure out a way to block it? Saving saying that he does think European bank consolidation is necessary, but he thinks there should be regulatory preconditions.
In my solemn moments before the show starts in the morning, I just do a bunch of calls to hedge funds that I know and see what they're trading. And actually, European banks are a big one on that consolidation story. And, you know, consolidation in the U.S. is still kind of difficult. We've gone through a round of failures. Let's see if it picks up here in the United States. But certainly it's an interesting story. I'll also point out, with our last minute of the show here, the S&P 500 for the week might at least end flat, if not higher. After we got that University of Michigan data at the top of the hour, you actually saw an even bigger lift in the stock market. The S&P 500 now up around 0.8%, really lifting those gains even higher here. 420 back on the 10-year mat. The NASDAQ 100 firm 7 weeks of gains.
Yeah, right now we see about 0.2% off for the week. The HCPW function helpful in that regard. I also wanted to point out that there is a Magnificent 7 ETF. I should have known, and you assured me that was the case. I double-checked and confirmed with Sarah Fagas and the ETF team. MAGS is the ticker. Of course there is.
Anyways, coming up Monday on Open Interest, we have Young Yu Ma of BMO and Shannon Schissel from Banrian Capital. Stick with us. It's a huge week of earnings. We'll bring it all to you. This is Bloomberg.
Good week.